All right, today we're going to pull back the curtain on the world of investment banking. We're going to break down what these financial powerhouses actually do, how they shape the entire economy, and maybe most importantly for you, what you really need to know to get your foot in the door.
Okay, let's just dive right in with a big question that really gets to the heart of all of this. Picture a successful startup. It's doing great, but how does it make that massive leap? How does it get its hands on the billions of dollars it needs to expand all over the world? Well, the answer is where our story really begins.
You know, that kind of funding, that scale of money, it doesn't come from your local bank branch down the street. Nope. It's all made possible by a totally different kind of financial institution, an investment bank. These guys operate on a global scale with a single mission to connect huge amounts of capital with huge opportunities.
So this is the first crucial thing that gets straight in your head. On one side, you've got commercial banks. They're for you and me, right? They take our deposits, give out loans. On the other side, you have investment banks, or IBs. They deal with giant corporations and even entire governments, raising insane amounts of capital and advising on these huge, complicated deals.
When you boil it all down, at their absolute core, investment banks are the essential middlemen of the financial world. And honestly, they perform one of the most vital functions in any modern economy.
Now, the fancy term for this is capital intermediation. Sounds complicated, I know, but it's really not. All it means is that they are master matchmakers. They find companies that need money to grow, and they connect them with investors who have that money and are looking to make a return on it. Simple as that.
And to really get how they pull this off, you have to see the world through their eyes. They are masters of two different but deeply connected arenas, what we call the primary market and the secondary market.
So let's make our first stop, the primary market. Think of this as the birthplace of new capital. This is where financial securities, like stocks and bonds, are created for the very, very first time.
Here's a really simple way to think about it. The primary market is like an author releasing a brand new book out into the world. A company creates new shares of its stock and sells them to the public for the first time, injecting all that fresh cash right into the business.
The key process here, the word you need to know, is underwriting. In our analogy, the investment bank acts like a high-stakes publisher. They basically agree to buy the company's new books, its stocks or bonds, and then they take on all the risk of selling them to the public, to investors.
Now, this slide is great because it takes something enormous, like a company's initial public offering, or IPO, and makes it understandable. I mean, think about Google's historic IPO way back in 2004. It was the investment banks, Morgan Stanley and Credit Suisse, that managed this exact four-step journey. They did all the intense background checks, figured out the perfect price for that first stock, and then took it on a worldwide roadshow to sell it to investors.
And this is where it gets really interesting, because it all comes down to how the banks manage risk. With a firm commitment, the bank is all in. They buy all the shares themselves, guaranteeing the company its money. It's a high-risk, high-reward bet. But in a best efforts deal, they're more like an agent, just promising to try their best to sell the shares for the company. But, and this is a big but, investment banks do so much more than just raise money. They are also incredibly high-level strategic advisors. They literally shape the structure of entire industries.
So think of them as corporate matchmakers and deal architects. They help companies find the absolute perfect partners to merge with or to acquire. They design these massive deals that can completely redefine a company's future. This is the famous world of mergers and acquisitions, or M&A.
And in the world of M&A, a banker can wear two different hats. On the sell side, their job is to help a client sell their company for the highest possible price. But on the buy side, they're helping a client find a strategic company to buy and then negotiating the best possible deal to get it. Now, this brings us to a really crucial link. Think about it. Why would anyone buy a brand new stock in the primary market? Well, a big reason is that they know they can sell it later if they need to. The primary market just couldn't exist without a healthy, active secondary market. Which brings us perfectly to our next stop, the secondary market. So, if the primary market is where securities are born, this is where they live out the rest of their lives, getting traded back and forth between countless investors.
Let's go back to our book analogy. If the primary market was the big book launch party, the secondary market is every single bookstore, every online marketplace, every library on the entire planet where that book can be bought, sold, and traded between readers over and over and over again.
And the IB's main job here is something called market making. What does that mean? It just means they are always standing by, ready to buy a security from someone who wants to sell or sell it to someone who wants to buy. This is what provides liquidity, and that just means the market keeps moving smoothly for everyone. You're never stuck.
And this whole massive operation is run by the sales and trading division. It's an incredibly dynamic team where salespeople are building relationships, traders are executing the deals, researchers are coming up with the big ideas, and structures are building custom-made financial products from scratch. So, after all that, why does any of this matter for your career? Let's take everything we just talked about and distill it down into a practical toolkit that you can take with you right into your MBA interviews.
Okay, first, if you remember nothing else, remember these 3 things. 1. IBs are the vital link between capital and opportunity. 2. In the primary market, their job is to create new capital through underwriting. And 3. In the secondary market, their job is to provide liquidity through market making. Got it? Good.
Now for the interview questions they're going to hit you with. You can bet they'll ask you to explain how banks manage risk. A total classic is to describe the difference between a firm commitment deal, where the bank takes on all the risk, and a best efforts deal, where the company keeps the risk.
They're also going to want to know you understand the ethics and the rules. A Chinese wall is that imaginary but very real legal barrier that separates a bank's private advisory side from its public trading side. You absolutely have to know why that barrier is so critical.
And finally, expect a question that tests if you can see the whole big picture. The secondary market, with all its liquidity, gives investors the confidence to buy brand new securities in the primary market because they know they'll always have a way to sell later. It's a critical feedback loop. So, there you have it. We've basically mapped out the entire engine of the capital markets, all the way from creating a new stock to trading it on the open market. The only question left is, in this incredibly complex and powerful machine, where do you see yourself fitting in?